Welcome to Ask an Advisor. I'm Krista DiBiase here with the Wes Moss.
Wes Moss. Hey, Krista.
Hello. We are going to talk investing as we do every single week on Tuesdays. I hope you're enjoying this episode. Please share it with a friend if you are subscribed. You could subscribe to our YouTube channel at youtube.com/Clark. And wherever you're listening, if you could follow the podcast, it really helps us out, and share with a friend.
All right, so we're going to be diving into a long list of Q&A today, which I love and kind of inspire. They're inspiring, I would say the questions are. And it always keeps me on my toes, makes me think. And today I wanted to just talk about investment myths. There's so many of them. I mean, maybe we probably do 100 of these. But really, let's just do, I think, 10 that just jump out. When I was sitting down kind of thinking this through, these are like the first 10 I got to. I think I couldn't stop at 10, so I have a bonus one and another bonus one. But I think we're going to get to 5 right now, and then we'll do the other 5 a little bit later in this same episode. But let's start with 10 investment myths.
All right.
First of all, what gets said oftentimes can sound right and make sense. Of course, that sounds right, but can be totally true or pretty misleading or mostly untrue, and that's why it's a myth. And there's a lot of them when it comes to the investing world, but they most of these sound like good ideas and they sound pretty much right, and maybe in some instances they do apply, but for the most part I think they mislead folks or they take people down the wrong path. So here are a couple of them, and I'll say them as if they really are true. So number one is you've got to be rich or wealthy to really invest.
It's super intimidating for so many people.
Number two, investment timing is everything. Really? How about this? Cash is king, especially in uncertain times. Of course that's true. Or is it a myth? Number 4, bonds. Bonds are they're safe. Maybe sometimes they are, sometimes they're not. Myth number 5, the stock market is like gambling. Who's going to argue with that? Stock market is like gambling. Well, is it? So those are the 5, and let's just talk these through. You have to be rich to invest. There was a time, and a lot of these have some legacy or anchor of truth, and the world has changed, and we still hear something said 50 years ago. Well, isn't it still a way that you grow up and it kind of passes down generation to generation? It sticks a little bit. But there was a time when it was only really wealthy investors who had a stockbroker on Wall Street that could afford to put extra money away and actually buy shares in a company. And that's just not true at all anymore. It's not for a select super wealthy audience. There's been great democratization when it comes to investing, particularly in anything in the public markets. It used to be $100 a share to buy a stock, or 50 ridiculous commissions. And then the big discount brokers came along and they went down to $50 and $25 and then $15 and $12 and $9 and $0. So there's trading costs have been virtually eliminated. So you don't have to spend a lot of money to invest. You're investing the money, and it's not necessarily, you don't have a big chunk going to someone else as a middleman. The online investment companies have totally brought down the walls on not just stocks, but on all sorts of categories, stocks, commodities, etc. It even used to be true not all that long ago that to get into private company deals was only for the really rich. It's the 100 millionaires and the billionaires, and they're the only people that can get into the private markets. There have been a flurry of companies that have brought even private investing down to minimum investment here, $1 million if you want to get into this private company deal. There are several companies that brought that down to $5,000 or $10,000. So the walls of isolation for the super rich have been mostly destroyed. And investing is not just for the rich. Investing can be accessed by anyone that wants to really be an investor.
Proven by so many people over the years. On Clark's birthday episode, So many people wrote in thanking him where they started with so little. I mean, that's just get rich slow, right? It's investing, dollar cost averaging, and
it really, I've seen it work so many times. Folks not making a ton of money, saving a little bit, but they're doing it. It's not the fastest investor. It's the investor with the most endurance. Number two, timing is everything. That, of course, timing is everything. Wouldn't I rather buy a stock or get into the market when it's down 20% than up 20%? The answer is that timing can help, but timing is not everything in the stock market. Participation is everything. So it kind of relates back to the first one. Participation is, first of all, you cannot ever have perfect anything when it comes to timing. The markets are too erratic. I mean, they'll react on a headline, a word, a social media post. There's no way to ever time. If we thought it was hard to time it 20 years ago and 10 years ago, it's got to be even harder today. So erratic in any given day because of headlines and news and media. So timing can help you, but because we can't ever have perfect timing over and over and over and over again, you have to default to what I think is the next best thing, and that's participation. Meaning that as long as you're participating for large chunks of time, and we're talking about the general equity markets here, that's really what matters, and that's what gets people rich. Timing is not everything. It may be something, but it is not everything in investing. Number three, cash is king. Cash is king. Every time there's a crisis, I think COVID, the housing crisis, even the tariffs earlier this year, and we're still in that world, but the market meltdown reaction to that, invariably, you're going to have people come on television and say, look, I've been in cash, and cash is king. Okay. You can't argue that you want to have some cash, but if you're an investor that is sitting out all the tough spots in the market in cash, the market leaves you behind. And when it recovers, you do not get that cash to work by and large because the market leaves you cash investors behind. Cash over time as well it's been an okay rate of return, depending on which period of time you're looking at it. It's been 2%, 3% a year on average. That really barely keeps up with inflation. So if you're a long-term cash investor, and of course we need to have some cash and some safety money, but if that is your overall investment strategy, it's not going to keep up with inflation over time. So cash is not king. It's good in measured doses. Bonds are always safe. Well, in some cases, really short-term, ultra high-quality U.S. government bonds, they are known as the risk-free rate. But there's a lot more to it than just short-term government bonds. There are intermediate-term and longer-term bonds. And the longer the duration of a bond maturity, so a 30-day bond, I would say that's very, very safe. A 30-year bond, that'll move in price as much as a stock will. Very erratic in price because there's you're way out on the seesaw, and as rates go down, those prices can go way up. Rates go up. A long-term bond can go way down in price. Not to mention the credit quality of bonds, and not every bond is going to have the ability to pay its owners back. So if you have a company that's doing well, all of a sudden it's not doing well, it could have problems paying interest and paying you back at maturity. So not all bonds are safe. Some bonds can be really safe, and some bonds can be really risky. Number 5, the stock market is like gambling. In the really short term, I would say that is true, is that in any given day, the market is a gamble. We don't know, even if you have good earnings numbers, stocks can still go down. And I think my company's going to do really well this quarter, and they do. Stock down 8%. What? So there is an element of risk and high uncertainty, a little bit like gambling in any given day, week, even in any given year. But over time, it's not that the house always wins. There's not a house.
Right.
It's your money. It's your house.
In fact, over time, if you're broadly invested, the house doesn't win, right? I mean, if there were a house, you win.
Yeah, but in implying that there's like somebody else wins, like a casino.
No, it's totally.
Now, maybe if you think the big investment companies, they rake money off of it. There's much less of that today.
Like if you gamble in a casino, you're set up statistically to fail. But if you dollar cost average your money and you stay in the stock market over a long period of time,
the odds are in your favor.
Your favor, right?
Not the house. So in a lot of ways, it is if you're in it for a long period of time, which by the way is the opposite of gambling. The longer you gamble, the more you lose.
Yes.
The longer you invest, the more over time we win. So it's really that is quite a myth that stock market is like gambling.
All right.
That's just the first 5.
All
Krista.
right. I'm excited for the next, 6 you said. You added an extra one in. We'll go to questions. This one came in from David in Georgia. I have most, if not all, of my investments or retirement accounts in mutual funds and would like to know where I am in terms of allocation for my overall portfolio. Do you know of a free app or website calculator that would be able to tell me what the percentage breakdown of my portfolio is in terms of stocks, bonds, and cash?
Okay. This has changed a lot over the years too. And so David's in mutual funds. Where can you get analysis? There was a time, I don't know if this was 15 years ago. I remember Morningstar, which still does a great job of what you're doing. So what David's trying to do here is if I've got 10 mutual funds or 5 mutual funds and they all have different stocks and all those funds are different, wouldn't it be nice to be able to see what the whole pie looks like? Mm-hmm. Top 10 holdings, overall yield. If there's a bond portion to the allocation, what's the duration? Are they short-term, intermediate, long-term bonds? What's the duration of those bonds? I've got 7 different funds, but what are really if I opened up the hood, what are the holdings? Mm-hmm. And there are tools that will do this. There was a time I remember you didn't even have to sign up. You could just plug these things in and get a nice report. That is not the case anymore. So yes, there are some free sites, but everyone that I've ever checked, you still have to sign up and make an account. Mm-hmm. So Empower does this, SigFig does this, Morningstar. That's an old elementary school one of my kids went to. Morningstar still does this, but you still have to have an account. So, and the reason you have to have an account and you have to either type in or upload your holdings, and then you can get this great report that shows everything that David is looking for. The catch is that they're going to be calling you and dripping on you because they're looking at your assets too and they want you as a client. Mm-hmm. The one way I think around that would be maybe you sign up for a month on something like Morningstar at a really nominal fee for the month, utilize the tools, and you don't have to keep being a subscriber the whole year. Now, there's one more way to do this, and this is pretty much brand new in the last year, and I would say, again, pretty much no cost if you already are using if you're already using an LLM like Perplexity, Claude, or GPT, you would be. It's remarkable at how they can X-ray different ETFs, different mutual funds for you. And what you used to have to use a service for, you can ask a language model and use AI and get almost anything you're looking for. Here are 10 funds. Well, you can get the duration, the yield, top 10 holdings, top 25 holdings, average market sizes, industry sectors, all through just using AI.
Wow. All right. Here's a question from Daniel in Iowa. I've heard the saying, comparison is the thief of joy. This saying sums up how I feel about my retirement savings when I listen to financial podcasts and I hear about people half my age with more money than I'll ever be able to save. For context, I'm 43. I make $50,000 a year. I have around $110,000 in my Roth IRA, $110,000 in a brokerage account, and $15,000 in my company 401k. I'm able to max out my Roth IRA every year and plan to do so with the catch-up after age 50 until 66 or so. I contribute 16% of my pay to my company 401k with a 50% match up to 6%. I've looked at all the retirement calculators, and to be honest, I'm not sure I believe them when most say that I will have about $1 million to $1.5 million in savings by age 66 based on a 7% return. I know that isn't a lot of money, but it probably enough to retire. But that being said, what would you suggest to avoid comparing what I have to what others have and not feel like a failure when looking at what others have done in a small amount of time compared to what's taken me years to save this much?
Daniel.
I bet a lot of people feel like that.
Yeah.
And doesn't Daniel have more than most people will ever have right now?
Daniel,
I mean,
you're ahead of what you think.
Yeah.
And now I don't have this perfectly memorized in my brain, but the Federal Reserve does this, the survey of consumer finances. And you can go in there, and I think the last time they updated the historical version that you can use is 2022. So it's been a couple years, but in the category that goes, I think it's 35 to 45, you're double the retirement savings of a lot of people.
Wow.
So you may feel like you're behind, but you're ahead when it comes to the average, and I think you're probably 4 or 5x above the median. Remember, the average is always going to be higher because, and this goes back to, and I love this, comparison is the thief of joy. You're so right about that. So I'm even playing into that by saying, well, you're actually, if you really do want to compare yourself to America, you're way ahead when it comes to the median number. You're way ahead, and you're even ahead when it comes to the average or the mean. Now, we just compared, so that's the thief of joy. So I shouldn't even have done that, but that's the reality.
Well, I think in this way, it's probably a good positive thing.
You're doing really well.
Yeah.
And I'm not based on looking around. But the only thing that we see, Daniel, you see home run. All you do is all we see are home runs. Nobody writes about singles and doubles. I read an article recently about three friends that started a chicken truck in LA. And one was a stand-up comedian, and it was his idea. Never done anything, like just not a business guy. $900. They started with $900. They sold 3 meals on their first night. It was like the hot chicken. I can't remember the name. Dave's Hot Chicken, something. Now they have 300 locations. They did $600 million in revenue and projected to do $1.2 billion. Just got bought by a private equity firm for $1 billion.
Wow,
that's a story. Are they gonna write about Daniel, who's saving 7% a year in his 401k? I guess we're talking about it, but the world is full of grand slam stories, not singles and doubles. And the reality is 99.9% of people that are going to end up wealthy are going to get there through the singles and doubles for a long period of time. That doesn't count. So you're also comparing yourself to people who get inheritance, people who can get lucky, right place, right time. Imagine if you were even the first 1,000 people that worked at Facebook. Well, those people are all multi-hundred millionaires because they happened to work at a company that mushroomed and was a mega grand slam. So those numbers skew the averages because there's a few of them that have a ton of money. And that's just not the reality. It's possible, but the vast majority of people are not in those situations.
I would also say he's comparing himself to other listeners of financial podcasts who are making it on the air. And I'm stunned. I've worked with Clark for 28 years. I'm stunned by what I hear some people have accumulated at their ages too. I mean, these people who are listening and writing into financial podcasts are really, really tuned. They are engaged and they are doing everything they can. And so that's definitely skewed too. I love listening to it because it inspires me to do more, but I definitely don't feel like I need to be Clark or them. I just do the best I can for me. And it sounds like he is on track and doing amazing with his salary, maxing out the Roth, all these things. I mean, wow.
Well, okay. So to answer your by the way, it would be great to do a survey and understand the average net worth of financial show podcast listeners to the general population. I bet you it's 3, 4, 5x.
Super skewed.
If you're listening to financial radio, podcasts, television, watching you probably have saved double, triple, quadruple the population. I don't have that would just be my guess. But then we go back to, and here's why the numbers, the questions that we've been getting over the last year, they don't surprise me at all. When somebody writes in and says I have $4 million or $5 million, I'm not surprised at all. Because anybody that's been listening to something like this for 25 years, they're going to probably get there. Maybe not 5 million, but Daniel, those calculators I've seen them happen in real life. over and over and over and over and over again. If you're maxing out your 401k, you're saving 10 or 20% a year, $500,000 a month at 7% a year when the equity markets have really done much more than that over time. That's just the math. It's hard to see it when you're at 50 grand and 200 grand, but all of a sudden you're at $1 million and the market's up 20%. Now you're at 1.2 million. You just made $200,000 in new net worth. It took you the first 10 years to get there, and it happened in a year. So that goes back to the compounding. It gets really evident in the later years, hard to see in the early years, but you're doing amazing. And just have faith, keep doing it. The system will eventually work over time.
All right, this is from Derek in New Jersey. Is a whole life policy a good way to plan for a special needs child? I have enough term insurance and am also contributing to an ABLE account. I pay $775 a month for a $500,000 death benefit with a long-term care rider. Am I better investing cash in an index fund or stay with the whole life policy? Of note, I am a high income earner.
Okay, so I think first of all, the ABLE account, which is a state account that I think in Georgia it's Georgia State, ABLE, stable, that it allows for you and family members to contribute a certain amount for someone that has a disability. So you're already doing that, which it sounds like for your son, which is amazing. If I'm doing some math here on $775 a month times 12, it's $9,300 a year you're putting towards a whole life policy. And if you did that for 30 years, you'd have contributed $279,000 to the policy. So that if you pass away, you get $500. So you've contributed, if you're contributing that long, you're putting in more than half of what you're getting back, and over a really long period of time. If you look at the internal rate of return on that, it's very low.
Yeah.
It's really low. And you'd probably be 50, 75, 100% higher if you were doing that same 775,000 and you were doing some sort of broad market index over the next 30 years. Now, we don't know I would say it would be much higher if you were investing that money in equities over time versus the most you can make, and you no longer, the caveat is you can't be here for it, it would be 500. So it's definitely not, well, it's certainly not in my book a really good way to maximize your investment return over time. Now, there is some stability to that. And yes, you can borrow from the cash value in your whole life policy. So it's not all bad and all wrong, and I think it can serve some sort of role or place in your overall planning. And maybe it's even more important if something does happen earlier in life. And that's why we buy life insurance, so that your son is taken care of with that insurance money in your family. So I'm not saying it's a bad thing, but it's covering you in that shorter period of time.
But isn't that what term life is for?
Right, and that's why I've actually I don't do any whole life myself. I've always just done term. It's the least expensive way to cover the risk, and that's really what life insurance is all about, of you not being here to be able to continue to earn for your family. So I like to maximize the insurance for the least amount of cost, which is just term, and then you would have much more money left over to invest that. That's buy term, invest the difference, and that's the way I look at doing it. So may not all be wrong because you're doing a lot of different things here. You're doing the ABLE account, you're doing the whole life policy, but that's a lot of money to be putting in every year for a whole life policy when you could be putting it in markets over time.
All right, we're going to take a quick break, and when we come back, you're going to get to the rest of those investing myths.
Welcome back to Ask an Advisor. I'm Wes Moss, along with Krista DiBiase. We've got some more myths to go through.
I know. I'm looking forward to that, and I have more questions for you as well. And if you have a question for Wes or for Clark Howard, you can go to clark.com/ask.
I guess a myth is just it's not a lie necessarily. It's a story that people believe that's not fully true. And that's what these are. There is a little bit of truth to them, but they're not completely true, and they're they overgeneralize, and I think that can hurt us as investors. So the number 6 on the list here, if the market goes down, you've lost money. If the market goes down, you've lost money. Sounds true. I should wait to invest until things feel better. Okay. Past performance tells you everything you need to know when it comes to investing. Real estate always goes up, doesn't it? That's a myth, of course. And then you need to beat the market to win. Or wouldn't it be nice to beat the market? That's the only way you really win. Again, all myths. We'll start with the first one. If the market's down, you've lost your money. So on paper, again, there's partially true. You have less value in your investment account if it goes from $100,000 down to $90,000. And we also know that one of the most popular benchmark, it's not the S&P 500, it is our own personal high water mark. That's what we're looking at as investors. Right. So if my account got up to $101,000, I'm always going to remember it got up to 101. So if it's anything less than that, if it's at 93, then I've, quote, lost money in my brain. And the reality here is that you're very rarely will you ever be sitting at your high water mark. There'll be a day when your account maybe makes a new high, or maybe another day it makes a new high, but it invariably is going to be dipping from that and then eventually catching up. So it's this escalator with lots of drops along the way. And if the market is down, no, you haven't lost money if you haven't sold, because a temporary loss does not mean it's a permanent loss. And that's why I think that is a myth. I've lost money. Well, not yet. You haven't sold. Stay invested to recover over time. I should wait till things calm down. It's the most, that one is the one I hear people say that every day. Every day. Should we just wait till these tariffs are all cleared up and we're just not dealing with this mess anymore? Well, when it comes to equity investing, that strategy, it's almost the opposite is true. It's really, if you look at in the most recent big correction, the time that you really wanted to be invested, and again, I'm going against my timing myth here, but if you're really looking at markets were at their worst or the best time to be buying or not selling out at least, was when we had maximum uncertainty. The volatility index, when it peaked at 55 earlier this year, the markets have almost been up ever since as the volatility has come down. So if we're waiting for no more uncertainty and everything to be cleared up, you're missing those times to be invested when you get a rebound. So that's another myth. Past performance tells you everything we need to know. So there is something to this. Past performance, I think, does matter. Why is Warren Buffett so popular? Because if you look at his investment history, it's been tremendous. So that matters, and that should not be discounted. We invest in the S&P 500 because we see over the last 20, 50, 100 years, it's done about 11% a year. So that past performance matters. But past performance really does not predict future results all the time, particularly in the shorter run. And I've seen several studies that show 5-star mutual funds that are 5-star because they had really good performance that invariably dropped down to 1 or 2-star funds because they had really good performance, but it's because they were somewhat in the right place at the right time. They were lucky in a trend, and then the trend goes the other way. So when it comes to picking a particular investment, yes, I think a super long-term track record is helpful, but if you're looking at an active mutual fund and you're relying on a team to be picking stocks, it sometimes can even be the opposite, is that they did really well, but it means now they're not going to do well because they were caught in a nice tailwind that and winds can change. The real estate always goes up. If you look generally over time, again, just like most investment assets, whether it's the stock market, whether it's gold, whether it's bonds, if you look over a really long, when I do this, I'm thinking about a chart. A chart like this doesn't really help. A chart like this really helps.
So you had little hands, chart like this, and then big wide hands.
For those long-term chart I'm looking at is that real estate has been pretty darn steady in an uptrend. However, we've had some massive, we remember the housing crisis. The housing prices peaked in 2006 and they went down for almost 2.5, 3 straight years. Housing prices went down nationally 35%. That's the average house. And then we saw some towns where we saw some really bubbly cities like Las Vegas and Miami and some towns in California where we saw real estate prices drop by 50%, 60%, sometimes 70%. So there is this nice feeling of if I buy real estate, I own an asset and I get some utility out of it, but it doesn't mean that the prices always go up. They go up over long periods of time. That's something that we can count on, but anything anything that's a year, 2, 3 years, absolutely, that's a myth that it always goes up.
Sure, and if you had the recent run up in real estate for so many people, if you're new to the market and you see that happen, you might think, oh, this is a no-brainer. But yeah, if you've been a long-term real estate investor, homeowner, you know that the ebbs and flows are real. And then the cost of owning a home, you have to think about that as well. A lot of times we don't think about that. The yearly maintenance costs, all the things.
Property taxes.
Yeah, the taxes, so.
Can be tremendous. Which can outweigh the appreciation. Mm-hmm. Your property taxes can outweigh, so the cost of carry can be outweighed by the appreciation. Myth number 10, you need to beat the market to win. And this reminds me of one of our questions, I think earlier today or over the last couple of weeks, are people thinking, gosh, it would be, if the market does 10 and I can do 11 or 12 or 15, then that's really how I can win. And the reality is here, that's another version of perfection. It's almost the cousin of perfect timing is beating the market. Those cousins they're not completely unattainable, but they're very unlikely that it's going to work out that way over time. You might beat the market in a given year or even a given couple of years, but it's really hard to continue to do that consistently over time. And you don't need to do it to win. When you do a retirement calculator, even though the stock market is averaged, call it 10%, a little more than that over a long period of time, even if you run those numbers at 7%, and if I think about just the mathematical rule, which is, how long does it take money to double certain percentages? The rule of 72, you divide 7.2 into 72 and you get 10. That means if you're averaging 7.2% a year, just mathematically, you double your money in 10 years. Mm-hmm. And that leads to winning. Your 100 goes to 2, your 2 goes to 4, and then your 4 goes to 800, and that's not with contributions, and that's only if you get that 7.2% rate of return. So it's very realistic to really win financially, and you don't need 10% a year to get it.
Okay. All right, let's go
to do a quick bonus.
Yeah, go ahead.
The quick bonus is just my overarching theme is that the happy retirement is all about money.
Oh, yes. That's so true. I know that only because of you, because of all your... Yeah.
Happy retirement, part of it is true. Half of it is about money. And the number one financial concern we have in this world, and it's tied with number 2, you would think would be number 1. I would think number 1 is health.
Right.
Health and wellness.
Sure.
That should be number 1. But in my recent research, tied for number 1 and actually even slightly higher if I'm looking granularly is financial concerns.
Like, will I run out of money?
Well, that's a different one. But my overall financial concerns in retirement are weigh on Americans just as much as will my health hold up. So money is really important just because it allows us to have comfort and a lack of anxiety and economic freedom. And it allows me to do the things that I want to do, which is the other after retirement, which is our core pursuits are our new purpose in retirement, which are all the things that we love to do. It doesn't need to be saving the world. It does need to be a full, robust schedule of the things you love to do and spend time to do it. And it takes some capital, it takes some assets to be able to do that. So money's an important part of retirement, but it's only half of the equation.
And then I guess you would add on, and we don't have to go through it all, we've talked about it, but the happiest retirees, like you're saying, it's not really all about money, it's about those core pursuits and all that, everything about your life.
Well, it's important to have some level of money,
right.
But we get also diminishing marginal returns or happiness per new dollar at a certain point.
I'm not even near retirement, but you've got me thinking about what pursuits am I going to have in retirement to stay happy.
What core pursuits that are you going to develop and curate and explore? Mm-hmm. So you want a bench of these core pursuits. And then what is your social network going to look like Because those two components are social network, your family, and your friends. Those three things, your core pursuits, your social network, family, friends, they cannot be understated. It is just as important as the money side of the equation.
All right, we'll go to questions. Darren in Tennessee wrote in with this one. I have professionally managed retirement accounts with Vanguard for me and my wife. The accounts include rollover 401ks, IRAs, active 401ks, brokerage accounts with cash, stocks, bonds, etc. We are still contributing every week above and beyond our 401ks. I get e-statements constantly that I don't have time to read. Total in the accounts is excess of $4 million. My question is, should I have someone audit my accounts every once in a while? Hopefully they're like a bank and they rarely screw up. What do you think? Am I asking for trouble?
The short answer is no. You don't need to hire an audit firm or even a CPA to do this, but you should be looking at your statements every month
And Vanguard has an advisor you could go to too.
Well, it sounds like he's in the Vanguard advisory program.
Yeah, must be, right?
So Darren, here's what I'm thinking is that, first of all, Vanguard, I've never heard of anything that's really, I've never known of a mistake or an issue with Vanguard. I just have not known that. And the knock on wood, I'm sure there are mistakes, but there's such a big asset management company. I would think if there is one, they will rectify it for you. And this is why you do want to pay attention to your statements. Think of this. If you're in the professionally managed group, and I don't know what you're getting charged for that, but let's call it a third of a percent I think is one fee that you could be charged. On $4 million, a third of a percent, it's approximately $12,000 a year. Now, it may be divided up in all your different accounts that are being managed, but if your fees are 15 and your accounts are at 4, then there's something wrong. If your fees are $5,000 a year and for the professionally managed fees and your account's $5 million, then maybe I wouldn't ask them any questions.
Right.
Because it's low. But the reality here is that you really do want to have a general idea of the numbers seem to make sense. And when something starts to not make sense, that's when you make a call and you try to get a real answer. And that takes not really an audit firm to do so. I think that's you as an investor can go through and just make sure that the fees and charges in those accounts line up. You're able to log in. This is the other, I think, advantage today to see if something's off. We can look at our accounts every day. I mean, if the market's up 20% in a year and your account is down for the year, maybe there's something wrong, I think it'd be less about a mistake and more about some sort of miscommunication. Hey, I thought I was in mostly stock funds. Turns out I was in all bond funds, and bonds were flat or down this year and stocks are up 20%. I think it's more likely that you would have a mistake that's a miscommunication between you and the firm versus they're charging you some giant number or money's leaving the account. Again, watch for all of that, but I think it's highly unlikely that you're going to have to deal with it. More likely it's a miscommunication, and that is why it's nice to be able to log in, look once a day, once a week, once a month, so that you know you're not off track.
All right, Patrick in New York says, my wife and I are maxing out our 401k, but also contributing to a retirement vacations brokerage account when we have any extra change to add. We're 35 now, so hoping to find a long-term portfolio for the money. Currently, we have about $42,000 in a Schwab Intelligent Portfolio robo-investor, but after reviewing the performance, it looks like investing in just the S&P 500 would have significantly better returns. Plus, they keep a good chunk of assets in cash, $3,000 currently, which we don't love. My question, would you cut ties with all of the funds in robo-investor, sell and reinvest elsewhere, or just keep that money invested with the robot and start fresh with a new brokerage account and try to earn better returns via good old-fashioned low-cost index funds? I'm not sure of the implications on liquidating a seemingly complex brokerage account. Thank you.
Patrick, so the short answer is if you've had the robo, and again, there's lots of different ways to be invested in a robo. There's 10, 20, 30 different ways usually. If you've had it for a while, you probably have a fair amount of gains, and I would be hesitant to close it down and do something else because you might have a bunch of taxes in order to do so. By the way, I love that you have a vacation brokerage account. How cool is that?
I know.
And it's already at $42,000. I mean, that's a lot of vacations. That's a lot of really nice trips. Especially as you let that grow over time. So first of all, I think it's cool that you're doing it that way. I love when people are bucketing money. It removes a little bit of our guilt to when we want to spend it. So there's that. I think that's good too. Most of these robos do hold some cash, and that's maybe one way they make a little bit extra money, but most of them now, and I'm not talking in particularly here about the one you mentioned, but they usually pay you commensurate cash rates. So if rates are at 3.5%, usually your robo cash should be at 3.5% too. So it shouldn't be that it's just sitting there doing nothing. And that may be part of a strategic allocation, but it's not a balanced portfolio with some cash, which that's almost 7%, and bonds and U.S. and international. There's really no way that would keep up with the S&P 500 because it's not the S&P 500. So over time, it's tough to beat. It's really hard for a balanced portfolio to keep up with a fully exposed, fully maxed out, no holds barred stock equity portfolio. That's the whole market, and it's hard for a balanced portfolio to beat that. I just know I wouldn't fold it down and pay a bunch of taxes in order to do something else. But what I would do, if you don't love this kind of an account, open another one and start contributing to that one. And then, yes, John Bogle, Clark Howard, Krista, we would all be proud if you're doing low-cost index funds.
All right. And this one comes in from Aaron in Ohio. I like to auto-invest in VFIAX in my Vanguard brokerage account, but it's not a smooth process to donate shares to my non-Vanguard donor advisory fund. DAF.
A DAF fund, yeah.
I'm thinking of using a brokerage account somewhere else, but would it cost me more to purchase VFIAX outside of Vanguard? I know that fund and other Vanguard funds are taxed like ETFs. Would auto-investing in an ETF at somewhere like Fidelity or Schwab be an option? Anything else you would recommend?
So, again, a mutual fund is 5 letters, and an ETF is usually 3. So you can tell the difference between the two. You can own these mutual funds that are, let's call it Vanguard, in Schwab or Fidelity. Most of those funds are all available, but you may end up with a transaction charge for those, and that's usually $25 or $30, somewhere in that neighborhood. So it does give you a little barrier to entry, and the very easy answer to that is that ETFs shouldn't have that problem, because ETFs are treated just like stocks, and you don't have a commission or a fee to buy them, and there should be no reinvestment fee as you're reinvesting your dividends. And there should be no problem when you're transferring, less of a problem when you're transferring money from an ETF to the DAF, or the donor advised fund. Now, I think it's really simple to have a donor advised fund and a brokerage account in the same company. That makes it super easy. That's how I do it. So I think that if you just go to an ETF portfolio versus mutual fund, you're bringing down the friction in the scenario of getting money into your donor advised fund. So I think ETFs are actually a really good answer.
Okay. Well, that does it for us today on Ask an Advisor. Thank you for being with us. Hope you have a great rest of your day. Clark will be back tomorrow with a brand new episode.